Welcome everyone to the webinar of Premier Brains, which is on likely impact of corporate taxes on free zones and mainland companies in UAE. As you know, Ministry of Finance has recently announced the corporate tax introduction into UAE, which is going to get implemented from 2023. So this webinar is basically to dive a little bit inside the expectations of the corporate tax. As we know, the law is not out as yet, but it's always better to anticipate and see how we can structure ourselves or plan in ahead of time before the corporate tax is introduced. So this session is mainly to dive a little bit into what to expect and how to prepare before the law is introduced. Just to give a little brief background about Premier Brains. Premier Brains was established way back in 2011. It's been roughly now 10 years into practice. So we have main office in Dubai, and then we have branch office in Abu Dhabi. Internationally, we have offices in Kuwait, Oman, and Bahrain. And what we do, we do external audit, internal audits, we do fraud investigations, liquidations, we are tax agent of FTA. So we do a lot of tax advisory work with a number of clients in UAE. And in GCC. And on the advisory front, we do valuation, merger acquisition work, we do work on business plan, feasibility studies, areas of that nature. Now, how does the Premier Brains stand out? We always believe in doing the right things and focus always on solving problems. This is what makes us different. So without taking much time, so let me go ahead and do a bit of introduction about the speakers. We are going to have 3 speakers today. I will be one of the speakers. So my name is Rishi Chawla. I'm partner in the firm. I'm a chartered accountant and MBA with experience over 18 years, with a lot of experience in this space, especially in the Middle East. I'm here for roughly now 16 years, so I completely understand how the market works. And the second speaker will be Jinesh, who is a senior tax manager with the firm with over 6 years of experience in Middle East, and he's a chartered accountant as well. Then we have Hemal, who is also a chartered accountant. He's also a tax manager with us with similar experience, more than 5 years experience in UAE particularly. So these are going to be the expert who will take us through the complexity, or I would say, how do we structure the plan? As we said, Premier Brains focus on problem solving approach. So we'll try to give you a little bit heads up how you can actually look at structuring things. So this is about it. So the agenda for today is going to be the impact on tax on free zones and mainland companies, and the likely deduction that might be applicable and what is not applicable based on our research in other GCC countries. As you know, the tax is not out as yet. Little bit about on the transfer pricing area, because there is indication that transfer pricing rules will be applicable in the corporate tax. So we'll just give you a little hint on what it is and what needs to be looked at. And then I will be taking the last session, which is on way forward, what companies can do, how normally it is done when a compliance such as corporate tax is implemented. We have experience when the VAT was coming. So we dealt with a number of companies in successfully managing those transitional times. So we'll share that experience with you. And then lastly will be the Q&A sessions. So with that, I'll hand over this webinar to Jinesh to take us through the first series of slides and educate us. Thank you.
Hey, thank you, Rishi, and good afternoon, everyone. So basically, we would like to touch base on the background of the corporate tax in UAE. So basically, what is a corporate tax? So there are direct and indirect taxes introduced in different countries. So corporate tax is basically a form of direct tax which is levied on the taxable profits of the business. So the taxable profit is basically generally the revenue minus there are certain allowed deductions under the respective tax laws, which my colleague Hemal will be taking up in detail in the later slides. So as you know, in case of an indirect tax like in VAT, where the burden of payment is transferred at every level of the supply chain, However, in case of a direct tax, the burden of taxation is usually on the companies that are earning the profit directly. So can we move on to the next slide, please? So why is UAE, which is traditionally being a tax haven, which has been one of the USP of the UAE, introducing the corporate tax at this stage? So basically in 2021, the UAE had pledged its support to the BEPS 2.0 initiative, which has a two-pillar approach. So the objective of these BEPS initiatives is basically to ensure that there is a fair distribution of taxation rights for various jurisdictions where the multinational operates. As you know, that the multinationals operate under different tax jurisdictions, and there is a possibility that there can be a shifting of profits from higher tax jurisdictions to lower tax jurisdictions. So there is a base erosion and a profit shifting that would happen. So to counter this, these initiatives were introduced by the OECD, and UAE, being one of the member of the inclusive framework, have pledged their support. And further to that, as we all know, that UAE is one of the most preferred destinations for investment in the Middle East and throughout the world, in fact. So it needs to align itself with the international best practices in taxation and ensure there is a complete tax transparency, and reiterate its position that it has been, it always focuses on compliances and ensure that the best practices are always in place. The UAE motto is always do 100%, and that's what they have done. They have come out with a very competitive tax regime, which is not competitive just in the Middle East, which has seen higher tax rates in other jurisdictions, like KSA has a 20% tax rate, Oman and Qatar, Kuwait, everyone has a tax rate. So this is not a new development, basically. Can we move on to the next slide, where we touch upon some of the key highlights which has been introduced. So basically at this stage, the MOF has released a few FAQs giving out the basic outline of the corporate tax in UAE. The legislation is still awaited on this. So basically all businesses and commercial activities, even the commercial activities or businesses conducted under a freelance license, are covered under the scope of the corporate tax in UAE. And as far as the tax slabs are concerned, so any profits up to 375,000 will be taxed at 0%, and any taxable income which is about 375,000 will be taxed at 9%. For large multinationals, which has group revenue of 750 million euros, that is about 3 million dirhams, will be governed under special tax rules, which is expected to be in line with the global minimum tax of 15%. But we will await further clarity on this once the regulations are out. And these corporate tax regime will be effective for all financial years starting from June 1, 2023. So businesses have quite a lot of time to get their house in order to ensure that they are compliant and consistent from a tax perspective. So basically, there are certain exclusion as well at this stage. So basically, income earned by the individuals from their salaries and their smaller investments are outside the scope of the UAE corporate taxation. Dividend and capital gains by UAE companies from its qualifying shareholding are also outside the scope, but there will be certain terms and conditions for that, which so the corporates will have to await the regulations on this. And the foreign investors' income from dividend and capital gains and royalties and other investment returns will also be outside the scope. This is also going to be subject to certain terms and conditions. So we'll have to wait on further details from this from the ministry. Can we move on to the next slide, please? So ever since the Ministry of Finance had announced that there will be an introduction of corporate tax, one of the hottest topic of the town is tax breaks that are offered by the free zones and how that will impact on the company setup here. So basically, from a company setup standpoint, the companies in UAE can be broadly demarcated into mainland companies. So basically, these mainland companies have the benefit of conducting their businesses anywhere within the UAE as well as outside the UAE. Whereas these free zones are basically geographically demarcated zones set up in different areas of the UAE, and they operate within the respective rules and regulations for such free zones. However, there is a limitation on them to conduct businesses in the with the mainland in UAE. They can do so through a branch or a registered agent, but they cannot directly do business with mainland companies. However, they can transact within the free zone and outside UAE. So let us take a look at some of the benefits that the free zone companies have offered. So basically, these free zones have a very user-friendly setup. It's very seamless. The process is, especially after the pandemic, has been digitized to a great extent, and they have a very robust department to support right from the initiation to the completion, and also they offer great assistance in the immigration processes. They offer repatriation of capital and profits. They have certain benefits on the import duties, which make the imports and exports quite competitive. And one of the biggest initiatives which will gain more traction now would be the tax breaks, because up until now there was a 0% corporate tax on most businesses in UAE. But the ministry has come out with the fact that there will be more benefits offered to this free zone. So this will be a potential game changer for the free zones. We move on to the next slide, please. So basically, the tax benefits under free zone. So there are currently over 40 free zones in the UAE that offer such tax breaks for the companies registered with them. They range, like the tax breaks range from 15 to 50 years. And however, of course, the companies will have to be subject to certain rules and regulations in order to be eligible for such benefits. So in our preliminary research so far, we have seen that some of the prominent free zones in the UAE, like the DMCC and the Jabal Ali free zone and the Shams free zone, they offer tax exemption from corporate tax for 50 years. And even the financial free zones offer a great amount of tax breaks from 50 years to 40 years, like the ADGM and the DIFC. Now, another burning question that has been doing rounds is the fact that these 50 years or exemptions or different year exemptions that are provided by these free zones, what would be their initiation period? So basically, from the DMCC website, which is one of the bigger free zones in UAE, it is mentioned that such exemption will apply from 50 years from the time of registration of the company. So this is going to be another area that the businesses will look into. So new setups will get a great amount of benefits. However, for other free zones, you may approach us at info@the.premier and you can visit our website also and lodge an inquiry, and we'll be able to assist you with further inquiries on these tax breaks. So basically, as of now, there are certain FAQs which broadly highlights that the UAE will continue to honor these tax breaks offered by the free zones. However, this will of course be subject to terms and conditions. So there will be further guidance once the ministry comes out with the full-fledged regulations and the legislations. And the free zones would still have to require to register for corporate tax and file a simplified annual corporate tax return and maintain all the records to ensure that they are following all the rules and regulations for claiming such benefits. We'll move on to the next, please. So what are basically the likely corporate tax impact of transactions between mainland and free zone? So let's say, for example, a free zone entity deals with the mainland. So that will, as of the information that we have right now, will attract a corporate tax. And in case the free zone only deals with free zone entities or entities outside UAE, they might not be subject to corporate tax. Of course, there will be special rules governing such transactions, and the businesses will need to ensure that such rules are followed. Another important thing to note is that the regulations will further specify conditions wherein a free zone entity will be dealing with mainland as well as free zones. So what would be the tax impact on that? Whether there will be a clubbing impact or whether there will be special rules. So we'll have to await more clarity on that. And in case of mainland, of course, they will attract corporate tax they will have corporate tax implication whether they do transaction with a free zone or a mainland company. Can we move on to the next, please? So basically, KSA also has corporate tax already implemented, and they also have such free zones. So we are touching base upon one of the free zones in the Isles, which is the special integrated logistics zones. So they have special tax rules, basically which specifies the rules and regulations that the entities set up under such free zones need to follow to get an eligibility of 0% tax rate. And they have to maintain special records for prescribed and non-prescribed activities. And the entities will, of course, need to maintain records for each tax year, because the tax implication might be different for different tax years for such entities. And they also need to follow and file an annual simplified tax declaration that it complies with the special tax regulations. So we can expect similar compliances from the free zones in UAE as well. And to continue on the slides and to continue on the special tax rule. So basically, the tax relief period for this ILZ free zone, which is based out of Saudi Arabia, says that the tax relief period would be earliest of the 50-year period from the date of obtaining the license, or when the entity ceases to be an established entity under that free zone. So it is clearly stated here that it's 50 years from the date of obtaining of the license. So thank you for your attention. For the next set of slides, I'll be handing over the presentation to my colleague Hemal, who will be giving more insights on the deduction front and transfer pricing. Thank you.
Thank you, Jinesh. Thank you, Jinesh, for the wonderful insights for the background of the corporate tax and what will be the impact in the free zone. So, and now I will like to go forward with the corporate tax deductions. So as Jinesh has mentioned earlier in the first slide, that corporate tax, basically tax will be charged on the net profit of the income, net profit of the company. So basically a company will earn income, then certain deductions will be allowed, and finally the net profit will be derived. So now the question is, what are the or which kind of deductions are allowed, and what are the basic conditions for that deduction? So as generally we have seen across the different corporate tax, below are the few criteria which allow as a corporate tax deduction. So that expense has to be a business expense and actual expense, and supported by the verifiable documents such as agreements copies or invoice or like contract between the entity and the supplier. Then other criteria is it is related to the taxable income. If it's not related to the taxable income or a business expense, then that deduction might not be allowed. Then the expense or a deduction allowed in the same year which it is incurred. So for the past year's expense, the deduction will not be allowed in the current year, in the tax year itself. Then other criteria is it has to be a non-capital nature. So capital nature assets like building or furniture, fixtures, plant and machinery, that will not be allowed as a deduction in the same year when it is purchased. So these are the general criteria business has to evaluate while doing the expense entries or while taking the deductions. Then next questions is, there are certain expenses which has a complex nature. So one of them is management salary. So we have seen that different GCC rules that management salary is capped at a certain level. Management cannot decide to give salary to reduce the profit burden. So basically that has to be kept at a certain level. Then the depreciation. For the depreciation on different, as we have seen in the previous slide, that capital assets are not allowed as a deduction, but the depreciation on such assets will be allowed as a deduction. So also for the different kind of asset, there are different kind of rates are there. So for building and land, we have seen that it's a huge life of 10 to 15 or 20 years. So rate can be ranged between 5 to 10%. Then another assets are plant and machineries or furniture fixtures. So for that, the rate can range between 20 to 25%. The then another complex area is loan charges or interest expense paid by the companies, maybe to the related parties. So here also we have seen that in a different legislature across the GCC that this interest expense or interest rates are kept at a certain level that cannot be your company cannot charge higher than that expenses, or if the higher rate is charged, corporate tax might disallow the expenses above whatever limits. Then another complex area is allocation of overheads cost to the branches. So in a UAE, there are like all the MNCs have a branch offices here, and they charge their certain expenses incurred at a actual level to the branches, like a management fee or recharge for the recharge expenses for the operations done at HO for the branch. So we have in GCC different countries we have seen that all the expenses will not be allowed. So in specifically in KSA corporate tax says that for this kind of a recharges only it will be allowed up to the 3% of the total revenue. So same practice we are expecting to see in the UAE corporate tax as well. So the next slide. So we have seen the allowable deductions, but there are certain deductions which is non-allowable for the calculation of a taxable profit for the company. So entertainment expense. Also, we have seen in the VAT law as well that VAT paid on the entertainment expenses is not allowed, and this entertainment expense basically includes event for like events or parties or sports or competitions or entertainment trips or activities are arranged for either for the employee or either for the clients, so that the same approach can be taken by the tax authorities for the disallowance of the entertainment expense. The other non-allowable deductions which we have seen across the GCC is that fines and penalties for breach of the law. So basically, for example, any company who is registered with a VAT and they have received any penalties from the FTA for the non-compliances. So whether it will be allowed under the corporate tax as a deduction. So here, what we have seen across the GCC is that this kind of a penalties or a fines will not be allowed as a deduction while calculating the net profit for the corporate tax. Then another, which I have mentioned earlier also, non-business expenses will not be allowed. So any expenses which has a personal nature or it is not for the business but has been paid from the business, so that expenses also will not be allowed for the deduction. Then another critical area is provisions. So generally businesses do a provision to comply with the IFRS or their future expenses. So one of the example is bad debt provisions. So what we have seen is that bad debt provision might not be allowed, or it will be allowed with a certain conditions, and there is a chances that actual bad debt which has been which has a loss for the company, that will be allowed as a deductions. So these are the few areas which is a company has to take a proper actions to identify which expenses are allowed, which expenses are not allowed, and accordingly they can do a classification. Then another question arises. So next slide is related to set off and carry forward of losses. So first of all, what is a set off? So set off loss, it means adjusted the loss which is when the company's deductible expenses increase above the company's actual profit. So in that case, company is earning a loss. So whether this losses for the particular year will be allowed in a next year, adjusted against the next year profit. So the different jurisdiction has a different criteria. So like if you can see in the KSA, the losses can be carried forward for the indefinite period. But the condition is that in the next year, you can only adjust 25% of the net profit from the carry forward losses. However, in Oman and Qatar, we have seen that the carry forward loss is limited to 5 years only. So if you have incurred a loss in year 2020, then you can take a credit of that loss in the up to 2025, and after that, that loss is gone. You can companies cannot take the credit of such losses. Also, the other thing is in case of cases 20%, 25% limit is there. But in Oman or Qatar, whether is these limits are there. So basically, they are saying you can set off the 100% loss of the previous year. So these are the different criterias we have seen in KSA, Oman, and Qatar. So it is expected that UAE also take any of this criteria, and they will allow the set off of the previous carry forward losses. So yeah, now the important or the most hot topic of the city discussion is the transfer pricing. First of all, let's understand what is transfer pricing. So transfer pricing is the price determined for the transactions that take place between two or more related parties of the MNCs. So that price is defined as a transfer pricing. So 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 whether UAE business or UAE or corporate has to follow the transfer pricing rules. So in FAQs issued by the Ministry of Finance, they have mentioned that UAE corporate or UAE businesses will need to comply with the transfer pricing rules, and they have to follow the OECD's transfer pricing guidelines, which are under which
meeting, no?
uh,
Yeah, Premier Banks this thing. Yeah.
sorry for the disturbance. Yeah. So basically, there are the whatever transactions between the related party that has to be done and the arm's length principle. So let's understand what is arm's length principle or what is arm's length transactions. When transactions between two enterprises Uh, sorry for the disturbance. Arm's length prices. What is arm's length prices or arm's length transactions? So when two enterprises act independently and enter into a transaction which is free from any influence, that will be considered as a arm's length transactions, and that will be the price between them. It will be considered as a arm's length price. So basically, it's a when this entity enter into transaction with any third party, what prices has been agreed, the same at the same prices the related parties also transits, then it will be considered as a arm's length pricing or arm's length transaction. So to understand with this in a brief, we can go through one example. So in scenario one, this is the transaction where the unrelated parties or the related parties enter into the transactions with the arm's length prices. So in this example, the entities are one entity is located in the X country where the corporate tax rate is 30%, and the another country, company is located in the UAE where the corporate tax rate is expected to be 9%. So here, company books a revenue of 800 and having a net profit of 350 and pays a tax on a 30% rate of 105. And for the company UAE, that will become a cost, and the revenue is booked. The product is sold at the final rate of 2500, and they book a profit of 400. So cumulative tax for this transaction will become 141. But if the transfer pricing rules or arm's length prices are not there, in such a case, the companies can do like they can a company X located in country X will book a sale at a 1500, and accordingly their profit will reduce to 50, and they have to pay a tax at the 30, only 15 USD. So another one in that case, the cumulative tax will come 78. So in these scenarios, we can see that if transfer pricing rules and regulations or arm's length prices are not there, the companies can shift the tax burden to the lower tax zone countries. So to avoid that, this transfer pricing and arm's length prices are necessary. Also, UAE MOF has mentioned in the FAQs issued that also UAE company has to follow the transfer pricing regulations. So this is a very necessary consideration. So next point is, while doing the transfer pricing evaluation, what point companies should address? So first of all, companies have to assess the transfer pricing risk. So what kind of a transfer pricing risk are available? They have to evaluate like a transaction size to be basically whatever transactions are done with the related party. Then companies has to do like understand the nature of these transactions, what are the tax attributes of the taxpayers, and what are the impacted tax jurisdictions, and they have to analyze the provisions or tax implications of their tax jurisdictions. Then how you benefit efficiently plan your transfer pricing policies. So companies, while rules transfer pricing rules are very complex and impose many documentation requirements. So company can go for an assessment, they can do a proper analysis of the tax jurisdictions where their entities are located, and accordingly the tax efficient policies can be defined. The other one is appropriate intercompany agreements has to be maintained. So we have seen in the UAE that there are so much intercompany transactions happen with the parent company which might be located outside UAE, and there might be not proper agreements available for those transactions also. So company has to recheck their documentation. They have to rearrange the agreements, rearrange the contracts to comply with the transfer pricing regulations. Also, companies also have to analyze the impact on the direct and indirect taxes because of the transfer pricing rules. So once company is restructuring or structuring their transactions with the related parties located outside, they have to analyze the impact of the VAT or GST in that countries. So these are the few considerations has to be done while doing the transfer pricing valuation. Okay. Then what are the documentation requirements for the affected entities who has to follow this transfer pricing rules and OECD guidelines? So there are mainly four categories are there. One is general documentation. So general document mainly consists of the organization structure, what are the business or industries the companies are dealing in, what are the transfer pricing methods companies are adopting it. So this documentation has to be maintained and kept at the company's locations. Then the another one is a master file. So basically, master file provides a high level overview of the M&E's transactions that consist of the overall group structure. So basically, this file has to be like a consolidated file for the all the group transactions and everything. This has to be maintained at the all the entities level. And the local files. So basically, these are the files maintained by the entity at a individual level, and that consists of all the details of the transactions, legal, financial, and tax arrangements within the other entities. And the another requirement is to do a CBCR filing, country by country reporting. So that has to be done at a holding company level. So these are the, like small insights related to the deductions and transfer pricing requirements to be fulfilled while the corporate tax comes into the picture. And now I would like to invite Rishi to take us to the way forward for the corporate tax.
Thank you, Hemal. Thank you, Hemal and Jinesh, for a wonderful session. You have really taken us to what to expect in the corporate tax, in the free zones and the mainland. And thanks for making that effort of doing your research in the GCC country. That's very helpful. Now, going to the next series of slides is basically what's going to be the way forward. So can I request you to go to the next slide? Thank you. So how to prepare for the corporate tax. So now before we start that, I'd like to share the experience we had at the time when the VAT was implemented. So, obviously what happened in any kind of a compliance structure, it comes with a lot of policies and structures and rules and regulations. So what we have experienced so far is that the companies who actually prepare well in advance before the law is implemented, they are in better control of doing proper reporting, and most importantly, avoid any kind of tax audits or any kind of questions being asked from the authorities. So in our opinion and experience, preparing in advance make a lot of difference. The first thing always starts with an impact assessment. Now the question is what we do in an impact assessment. So as you might have seen to the session which shared by Jinesh and Hemal, there are things such as rules which have never been in place, like transfer pricing rules, which we know is there in Saudi, where they follow, and the rules are very strict. However, in UAE, as such, there is no transfer pricing. Like many cases, we get to hear from clients, they ask us, now what do they do in case, recently I was speaking to somebody from Singapore, and they said that what are the rules for arm's length transaction? At that time, of course, we didn't have, but now the rules are in place. So it's very important that this to be really taken into consideration for any kind of related party agreements in place. Another thing important which can be done, such as whether there are agreements in place or not. From our experience also says that in the mainland companies, though the memorandum of association says that the tax the law says that you have to have the audits done every year, but the companies are still not doing, because at the time of renewal, such audits are not being asked. But with the corporate tax specifically coming into picture, I think the audits will become one of the mandatory requirement. And thus the company should do the audits in advance. Now the question is, if the audit is required, then you might think, okay, fine, when the audit is due, we will do the audit. But one thing one should remember is that if there are any changes done now, for example, say today the tax gets implemented and we do the change now, so that the tax authorities very much are aware that the changes being done right now should be something very consistent from the past. So if you are into that phase of implementing new changes or bringing arm's length transaction or bringing some deductions, say some people might not be charging management salary, or some people might not have the vehicles in their company, but they start to move those expenses into the company. So if you do it when the tax law is implemented, it becomes quite late. So what is important at the impact assessment stage is to understand what kind of tax planning can be done, what kind of structuring can be done right now, rather than doing it once the tax law is already implemented. That's very important. Another thing to look at this stage and impact could be whether to form a tax group or not. What are the benefits of having a tax group, and what are the disadvantages of having a tax group? So that has to be looked at. Another thing could be whether to operate from a free zone, whether to operate from mainland company. How do you deal with transactions which are with the mainland company if you are in a free zone? So what kind of structures in place to be ready with in advance before the law comes into picture? So these are some of the high-level things I would say to be looked at the initial stage. And the second stage then comes the detailed assessment and design. This happens when the law has actually been announced, so we know then what are the nitty-gritty, what are the one-line points which needs to be looked at. So the reason why we are saying impact assessment should be done earlier than doing a detailed assessment and design later on is, first is that it takes time to actually do those kind of changes in the company. And secondly, once the law is actually introduced, there is very little time. Like I remember when the VAT got implemented, the executive regulation were introduced just about a month or 2 months before the law is supposed to come into force. So do not wait for the law to get introduced. Do the action right now, because we are not much far away, roughly a year and a quarter from now that the law will be implemented. So it's very important that the company should start right away rather than waiting too long for it. And then the third stage comes the implement. Implement is then, okay, fine, tomorrow the tax law is coming into picture. Now what do we do? So the system start, whether the team is trained, they know how to record expenses, what to record expenses, what kind of backup, what kind of information they need to have before they record any expenses in the books. Because the thing is, if you record certain expenses or you do certain transaction, it not only impacts your corporate tax, it also has overbearing of your VAT. So for example, if you have agreements with related party, you're reporting in a particular way and charging VAT on those. Now with the arm's length transactions, you might have to change those rates. But if you have already raised the invoices on VAT side, so how does that get controlled? So all that has to be done well before at the impact assessment stage or at the detail assessment stage. But when it comes to implement, it should be right, plug and play. So one should be ready. So that is the time your system should be ready, the team should be ready, and you should have a system of registration for the corporate tax or the tax group should be done right away, and then plan for filing the tax return, which is already discussed by my colleagues. And operate is the ongoing process of filing your tax return on an annual basis. So can we go to the next slide, please? So from our experience, there are three things which are most important in any kind of a compliance structure. Technology, we understand without technology, we cannot function, we cannot file return, the time is there, right? So that's very obvious. The process makes a lot of difference because the way structure works in terms of the documentation, the type of agreement, especially the related party agreement. Normally in UAE, obviously the established company have their global practices of having agreements in place, but many times some companies do not have agreements in place. So invoices, being a related party, what makes it easier is that they understand each other. For example, like if we do transactions with Kuwait, we know, okay, fine, we understand each other and we might not have an agreement in place. So right now we should have official agreements in place. We should have basis why this arm's length transaction. Those kind of clarification should be there, because what we need to understand is the rate of corporate tax in UAE is going to be 9%. However, in the other countries, it could be 20+%. So the governments are really concerned about the transfer pricing rules. So you have to be sure about the right rates and proper agreements in place, and that should have a little bit of a length attached to it. It should not happen like tomorrow the tax is getting implemented and we have the rates right there. So there should be some history around it. That's why. So the process makes a lot of difference. So at the impact stage itself, actually, if you have the processes in place, the life gets easier with that. And also, if you have the audits and things like that is done, then the process is set. So there's a expectation which is built over time, not like it's a change that has just happened. So that's important. And the most important, of course, the people, because the people will make things happen everywhere. So in the corporate tax, specifically, people makes a lot of difference. The people who should be trained in advising you properly, what kind of, say, rules are there in the corporate tax in terms of, say, depreciation rates, say the management fees or other complexities which we expect it to come. And also the arm's length related research which needs to be. So the right kind of people to handle the corporate tax is very, very important. So plan that in ahead, who are going to be your leaders or your consultants who are going to take you through this run. Specifically, any law when it comes, first 2-3 years are the most challenging ones. So prepare well for that time, right? So can we go to the next one? Okay, so these are some of the action steps which businesses can take, and this is just one-liners from our experience. So restructure existing accounting, I would say, not the tax, the accounting reporting, so that it is tax efficient. So when we say tax efficient, some of the example I can use is, many times there are owners have the vehicles, so they're using the vehicles for company purpose. And since, okay, fine, say for example a sole proprietor would think, okay, I am the owner of the company, this is my vehicle, why should I pay extra money to put it to the company? Let it run like this. Anyway, in the VAT, if it is available for you, if that asset is available for you, you cannot claim the input VAT. So it doesn't matter, let it go. But in the corporate tax, it doesn't work like that. You cannot just straight away put your the expenses of your personal expenses into the company. You have to really create a wall between your personal expenses and the company expenses. So as we know, a company is a separate legal entity. It has its own legal existence. So that has to be understood and accepted, very important. So all the expenses, when it goes to the company, it has to be tax efficient, means it really, the documentation is going to be the key. The documentation really speaks for itself, because just in the world of law, documentation speaks. It's not we, like for example, if you go to court and try to justify a thing, doesn't work that way. It has to go through a documentation. So in the corporate tax environment, if your structure is going with a lot of understanding, it's not the right approach. You have to make it really tax efficient by having enough documentation in place. Very important. Then align the tax and transfer pricing policies as per OECD guidelines. So now in the FAQs released by Ministry of Finance, they have clarified that they'll be following transfer pricing rules in the OECD guidelines. So OECD guidelines, it sounds very simple, but there is a lengthy set of documents which are there to be read and understood and implemented. So look at that. I think take help of, if you have somebody experience in your organization or a good consultant, talk to them, take their help initially, specifically to understand the transfer pricing rule, because UAE being a country where a lot of transactions happen internationally, so very rarely companies do just the domestic work. So everybody, in my opinion, should know the transfer pricing rule, because one way or the other, or at some point in time, you have to face it. So understanding that the basics makes a lot of difference. Then review the existing your financial records and controls. So the controls in practice, the records is kept. How strong is your documentation? Whether the documentation is in the hard copies or is in the soft copies. The kind of servers, the kind of controls from a ransomware, and those kind of areas. How you're keeping your backup. These kind of things should be looked at. Of course, in the VAT, the same applies. But in case still there is some room, because in the VAT, people are more concerned about, okay, fine, you have charged the VAT on your invoices and you have claimed the input VAT on your supply invoices. So this is the record which is most important, because the tax authority will ask for it. Now with the corporate tax, all your transactions comes into picture, including the management fees, including the agreements, including the transaction where there is no VAT, your salary expenses, your labor contracts, everything comes into picture. So keeping a full length view of your record keeping is important to be understood right now. Then IT infrastructure is definitely, after the COVID hit, I'm sure companies are more planned and structured in IT infrastructure. But what our experience says is that the system is there, but the filing structure might not be there. So okay, the files are logged in or sitting in your systems, but where is it lying? Is it really structured in properly? It's really been put into proper folders and controls are there or not? So that kind of still a structure, and how the backup is done and who keeps the backup. This is still one of the missing link in the small companies we have noted. In the big companies, obviously they have the servers, they do daily backups. So all structures are there. So this is an important area definitely to look into. And review and updating your management process. So when we say the management process is how you enter the agreements, what are the documents, so what kind of assets you are using, who the asset belongs to whom. So like if there are certain assets in the company and you don't have documentation in place, so how are you going to claim the depreciation those assets? So, okay, when the corporate tax comes into picture, obviously all the documentation will play the key. So the first year is going to be the most challenging one. So really a deep dive into that area is very important. And create awareness of stakeholders on tax. This is, I think, the most critical one, because you have to have the stakeholder on your side. Because what happens is the expectation from the stakeholders always is that there is an accountant, or there's a finance manager, or there is a managing say office manager in the company who knows everything, and they are taking care. So the expectation is they are taking care of it. So everything is okay, no problem. But every law, for example, even for us, the more we study, the better we become, the more comfortable we get. but it depends upon how much time is put into it. So the stakeholder should be made aware that there is a little bit of time required to be spent on this. There is a dedicated team that needs to go into it and to ensure that things are in proper place. So with that, can we go to the next slide? I think that this is the last slide for me. So I think now we are in the question and answer session. So if you have any particular questions, please type it in the chat window. We'll be happy to answer for you. So Hemal and Jinesh, can you join me as well? Right, I think we have a few questions. So I got actually 2 questions with me, which I got personal message to me, and there is one question asked by Haida, which I like to take it right away. Are forex losses and gains affect in the competition of corporate tax? Jinesh, you have anything to say on this?
Yes. So basically, while we await for the guidance, if you look at other jurisdictions like for Singapore, so this is again a very complicated matter, like my colleague Hemal mentioned during his presentation, that there are certain rules and regulations and allowances and disallowances for expenses under the tax regime. So let's say for Singapore, under the Singapore regime, you have to identify whether such forex expenses, gains and losses are revenue or capital in nature, and whether they belong to an income which is accrued and arised in there. And in case of realized, or so Singapore has taxation for revenue-based capital gains and losses. So such gains or losses are taxable, even if they are unrealized as per the revised guidelines. So of course, there is a lot of complexity involved, and there are a lot of specifics that we need to look into. So we would await the regulations for further clarification on such matters.
Right. Thanks, Jinesh. I hope that answers your question. If you have more on that, please write it to us. And secondly, so you can always, in case you have any questions, you can always write it to us at info@premier-brains.com. Yash, can you type in that address where people can contact us if they have any questions? Just put it on the chat window. And another question which I have got is that is audit going to be compulsory? So in this particular point, I like to mention that audit was anyway compulsory. If you look at the memorandum of association of your company, if you're a mainland company, the audit is one of the things which is already there. And then we also have certain free zones. Most of the free zones, definitely all the big free zones are doing the audits. So audit is always there, but it's just whether, the attitude being when it's asked for the license renewal, the audit is done. So with the corporate tax coming in picture, this is the only one document which gives a little bit of visibility to the tax authorities into the company. So audit is definitely going to be compulsory. So if you're not doing it, I would say, please do carry on the audit. Even we being an auditing company, we get ourselves audited by another company, because our records is very, very important, not only for our stakeholder, for any external parties. This is going to be important. So create a structure for compliance and visibility for the outside world. So that's going to be very, very important. We've got one more question from Azhar. Azhar says, will deferred tax assets or liabilities are likely to come into effect provided the timing difference and deferred tax rates as per CT and books as proposed by management? Hemal, you have anything to say on this, or Jinesh?
Yeah, basically, I guess the deferred tax rules will definitely be in place for this as such, because there will be different rates for depreciation and other matters that will be covered under the tax regime. So we do expect that deferred tax assets and liabilities to come into picture. So, but for further details, of course, we'll have to wait for the legislation.
Right. Yeah, with the tax rules, I also personally think the deferred tax asset and liabilities will come in picture, because there will be timing differences, definitely, because the rates, normally in the corporate taxes is going to be different from what is usually been implemented by the company. So there will be definitely some working on that. So more work for the auditors, I guess. Right. So we have another question from Rashita. She says, will SMEs be required to comply with IFRS? Rashida, to answer this question, IFRS is the most acceptable standard in UAE. Actually, all the financials in UAE are done under IFRS only. So all the SMEs, if they do the audit, definitely they are following the IFRS standards. So yes, I think it is going to be there, but we do also have the SME IFRS as well if companies want to follow that. But definitely IFRS is going to be implemented, and the corporate tax, like in the corporate tax, I would expect the IFRS financials is going to be the best way to go for your reporting whenever it is required.
Further to add to Rashid's just a brief thing is that the Ministry of Finance has also in their FAQs mentioned that the book profits should be in line with generally accepted accounting standards. And like Rishi mentioned that in UAE, the acceptable standards are the most preferred standards are the IFRSs. So yes, definitely the SMEs will be required to comply with the IFRSs.
Right. I've got another the question which says that the question says, what do you think? Is it better to open a company in a free zone or in mainland? It's a difficult one. What do you think?
I guess with the benefits that the free zone are offering, but right now, as we have seen from practical experiences, that all the rules and regulations that are mentioned on the FAQs might not be strictly followed. So the business will have to reassess their business models as to whether what kind of businesses and in what geographical areas do they need to operate in. So if they are planning to operate in free zones only or outside outside the UAE only, I think free zones might offer them better benefits. But of course, we'll have to wait. As we have seen in case of Saudi free zones, they have come out with special rules for this. So we'll have to await on more clarifications. So businesses will have to look at it individually based on their business models.
Yeah, I completely agree with that. Reason being, if the companies are going to do a lot of mainland business or local business, it makes a difference to have a mainland company, because now the 100% rules allows you to own 100% ownership. That is good. So it's a choice to make. And also a lot of companies or the government sector would expect to deal with mainland companies than the free zone companies. So there can be challenges of such nature. So it's a question to be looked at, but we should also understand that 9% tax rate is not a huge tax rate, but at the same time, it gives you a lot of freedom to work in UAE. So if you have to really work in a country, it's always good to pay the taxes for the welfare and growth of the country. So it's a decision to be taken whether you are doing more business in the mainland or in the UAE, or you're doing a lot of international business, and accordingly take that informed decision, I would say. Azhar says that the emphasis is on operating net profits before taxes. So, sir, who will certify the profits, be it professional members or relevant government authority before filing tax return?
Yes. Touch upon that. Basically, the taxations are more in the nature of self-assessment. So the businesses will have to self-assess their tax liabilities and the compliances that they would need to adhere to. Of course, considering the complexities, it is always advisable to involve professionals, especially at the earlier stage, to ensure that, the impact on the transaction, because every business will have their different set of business models and the way the businesses are structured. So we would definitely recommend to go for professional advice. However, to answer your question simply, it's a self-assessment, so the businesses would themselves need to assess.
Thank you so much. I think I think now we are at the end of this session, and thank you everyone for joining. So goodbye for now. If you have any questions, please write it to us at info@premier-brains.com. And we always believe in helping wherever we can to help you take informed decisions. So goodbye for now.
Thank you so much, everyone.
Thank you so much, everyone.
Thank you. Bye.